Good day, fellow investors. There is a lot of talk about 50% crashes ahead. Michael Burry has been correct in his past predictions and always usually 1 to 2 years late. So in this video we'll discuss the scenario of what has to happen for the S&P 500 to crash 50%. I recently made a video how it is possible that in the next 7-10 years the S&P 500 goes to 8,000 points. It's very possible. But then again, it's also possible that before that happens, it goes first down to 2000. So let's discuss both scenarios. In the 8000 points scenario, I simply said that if earnings grow from the current 203 to 320, so 50% in 8 years, that's not much. Given inflation, I don't know, 7%, that's it. And then give it a P ratio of 25, which hasn't been that uncommon over the last 25 years, so P ratio of 25, you are easily to 8,000 points. And that is based on inflation and more money printing. So if we look at what the Fed did to its balance sheet over the years, expanded 9 times, the S&P 500 followed. If there is a next crisis, it will expand again. The full video, you have it in the link in the description below. But then the eagle said, no way that it goes to 8,000 points, so 1 in 100,000 chance, I say. I think it's more about 25. At the end, we'll say also the chances of going to 2,000. So this is at some point over the next, let's say, 8 years, and at some point over the next 8 years, it might also go to 2000. We will see more about that. Liu says how I completely ignored the Fed and interest rate hikes. Michael Burry sold, so he has a point about interest rates hikes, slashing growth and earnings together with inflation. And Liu is completely correct. That's the scenario we will discuss in this video. So let's look at the current situation of the S&P 500. Over the last days it was above 4,000, so I'm going to take an average of 4,000. But if you look at it over the last 40 years, it was 120, then interest rates started to going lower, exuberance, then it crashed 50%, then it crashed 50%, and now we had the pandemic scare here, exuberance, Fed printing, and now it is already down. How much are we year to date? We had a bear market here, then rebound. What Burry says, it's a bear market, typical rebound for it to crash another 50% down to 2,000 points. Now let's see the situation from a fundamental perspective. If we look at the current P ratio of the S&P 500, it is at 20. So 20 times 200 earnings, you have a 4,000 level. But if you look at the developments over time, earnings were around 110 and now over 10 years went to 203. Many expect that these 203 will just continue to go higher, but it can also happen differently. Because we have to check, okay, what can happen differently to see the S&P 500 fall to 2000? And that's another very realistic scenario. If we look at earnings in the past, 2007 to 2008 or 2006, let's say from 100, it went down 80%. So earnings can decline and remain down for a year or be lower than the previous level. So don't expect earnings to grow forever. In the 2000s, earnings went from 85 to 40, so another 50% down, and then it took some time to get back to the 85. So 5 years. If this happens, if we have 2 years of earnings down at 100 and staying down for a year or two, that's a 50% crash of the S&P 500. That's what Burry is warning us. It happens every 10 years. It hasn't happened for a while. And the key here to understand is that earnings can also not grow or fall 50 or 80% and then stay down for a while. Nobody can have the patience to hold for when it is down, to hold here. Let's say that it crashes to 150% from the current 200, then it would be a P ratio of 40 for the S&P 500. Very few will hold the S&P 500 for 2 years at a P ratio of 40. Maybe then it will fall to 20, and then you have 20 times 100 is 2,000 points for a 50% crash from the current level. Don't focus on estimates. Estimates are always positive, always on the upside. We'll discuss that more in the margin of safety, Wall Street's bullish bias soon. So Wall Street is always bullish, also bullying you, but okay, that's Wall Street. And you have to understand that these estimates might be completely wrong, and that from the current 203, 208, we can easily fall to 100 in EPS, no matter analysts' predictions. They do not implement recessions or things like that, shocks, in their models. And simple mathematics, if we hit 100 earnings per share times a P ratio of 15, we are at 1,500 points for the S&P 500, which is a big crash. What's that? 60%. How can earnings go down 50%? What happened the last 2 times that those went down 50% and more? We can have a recession, stagflation, structural changes, taxes, populism, whatever, geopolitical issues, or we can have simply the Fed abandoning a soft landing try and going for, let's say, a short but weak recession to cut inflation, not really an inflation. The fact is that you never know how will inflation react. Not even they know, but if you want to lower inflation, you need to have a recession, you need to increase interest rates, everyone is in debt, so earnings go down, spending goes down, and it can get really ugly because at some point the fundamentals hit you. Druckenmiller says that there has never been a situation where inflation was above 5%, that inflation was lowered without a recession. So we can easily get a recession as inflation is much higher than the Fed's target. Also, never has inflation fallen without interest rates going above it. It's unlikely that interest rates will need to go to 7% to curb inflation or 9%. Maybe just at 4 or 5% will be enough to curb inflation. So this might be a first time in history, but already this, given the debt, will create a recession. And the question is whether it will stop inflation. Nobody knows. Maybe we'll just have stagflation. And if we look at what the Fed did, so if you look at interest rates here, this is the 10-year Treasury, it was 1.5%, so not really meaningful. As the Fed started hiking, well, that started exactly at the end of 2021, and you know that the stock market, as rates went up, went down. If that happens, then you will have a continuous crash. If Powell has to push to 5% to curb inflation, push it into a recession, and the 10-year Treasury is at 7%, which is usually the benchmark also for valuation of other assets, we have a P ratio of 15, a recession, and that is, let's say, 100 or 150 earnings times 15. You are around 2,250 points for the S&P 500. Can happen very easily, maybe even 50% chance that we hit these 2,250 or 2,000 or something. Then discussing what Burry tweets, and he keeps asking when will the crash happen. So we had this, the bounce, and then under his projections we have this to the 2,000. Very interesting tweets from Michael Burry. So inflation has always been peaky, and it never has been just one peak. So also that is something to understand. It resolves to a brief deflation or disinflation and comes back. So an inflationary cycle generally spans for years, and inflationary eras have spanned decades. If that happens, we might see in the 1970s for stocks 15 years of zero returns with many 50% crashes. That can happen because the Fed loses and has lost control. Why it hasn't been a doomsday scenario over the last 40 years? Because of that. Here he uses nominal GDP, total public debt. I have taken a maybe simpler chart. Just look at total public debt as a percent of gross domestic product. So over the last 40 years, crisis, disinflation, high inflation, this was terrible for stocks, and doomsday scenario. Over the last 40 years, we have seen no doomsday scenario because with every crisis, there has been the possibility to increase debt levels. When this possibility is gone for the next shock, trust me, the next shock will come sooner or later. When that happens, then doomsday scenario that Michael Burry predicts here, this is the debt line, this is debt to real GDP and debt to nominal GDP. So that increases constantly, and therefore we haven't seen a shock. And quite rarely, given quantitative tightening, right, that rally is gone, but quantitative tightening might be just a word because mortgage-backed securities holdings have actually increased since the start of quantitative tightening. So the Fed can't really do what it has to do now, and here you can have mortgage-backed securities increasing actually a little bit. The total holdings are 8.3 billion here, 8.39 billion, so down 50 billion. But what is 50 billion on 8 billion? What if the Fed needs to make it down 500 billion? That can be reflected into the markets, and then again you have a 50% crash. Nobody knows what will happen, but Burry then also discusses 22% rally, 42% rally, and then in relation to history, down another 50% from where we are now. How these rallies are normal, habitually be 1-2 years early on literally everything, and you can attain broken clock status. So dead cat bounces are the most epic. Everything has happened in history, and we might be hitting again a wall and seeing it down. Nobody knows what will happen, but I think that 2000, it's also something that can easily happen here or there. Then the Fed might react, and then we might also see 2000, let's say big chance, and then in 8 years see 8000. Keep in mind these 8,000 are nominal, and maybe it will not go anywhere in real terms. That's the key difference. With inflation, we might see 8,000, but no real returns. And now how to invest? We might be into the 1969, 1982, or 1966 period with 15 years of zero nominal returns, 75% negative real returns. How to invest? Well, in that period, value investing did really well. 20% of the lowest PE and price to book businesses back then did 10x, while the S&P did 0x, just dividends. So value investing might shine over the next 10 years. We will see. We will always do value investing and then see how it goes. The key on the market is that there will likely be positive nominal returns as the Fed is limited in its actions, but negative real returns. If we have 7.3% inflation, the S&P doubles in 10 years, that is still a negative real return. Keep that in mind, because then inflation is 7.3%, doubling in 10 years is 7.2%, minus 0.1% return long term. What to do? I feel that the party of easy investing stocks go always up might be over for the next decade or two. Too much debt, too much money printing. Go for fundamentals, quality, long-term business focus that will do well no matter what the Fed farts in Jackson Holes or from other holes. That's investing. Thanks for watching. We'll do more scenarios trying to understand risk and reward, and especially try to educate you on value investing and how to obtain that margin of safety. Subscribe for that. We are doing the book summary too. Thanks for watching. I'll see you in the next video.